Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I'm very excited to be here with all of you today, as we do every single week. Because for us, information without education always leads to failure. So one of the things that we try to do at Cambridge every single week, and we get to accomplish that because it happens to be our number one goal, is to be able to share information that you can then turn into education. And on top of that, we also want to share ideas for all of you to be able to maximize your retirement plans. Now, as all of you know, we're a retirement strategist firm. I have been a retirement strategist, although I have been in the industry for almost 30 years. But I decided to specialize in retirement strategies approximately 20 years ago. So that's all that we have been doing ever since. So today's webcast is going to be, and podcast is going to be on the importance of principal protection in retirement. This is the major issue that we deal with whenever we engage a client for the first time. Most of the clients that come to see us, their investments are all over the place. You know, they have the vast majority of their investments in mutual funds, stocks. Very few of them have a good, sound portfolio of investments where they do have conservative investments like bonds, some real estate, and so forth. But at the end of the day, none of them have principal protection as part of their retirement strategies from a business perspective. Now, Nancy Duarte said many years ago that the future isn't a place that you're going to, it's a place that you get to create. And I'm a true believer in that, because when it comes to retirement distribution planning, it is not something that you go to. It is something that you get to create. And the more time you have to create your retirement strategies in the future, the better off you're going to be. I have had clients that have come into my office 3 months, 60 days before they retire, and they want to go back and try to fix everything, and they only have 60 days to go. The probability of us being able to help them is very high, but then it's going to take longer, you know, for the planning effect and the recommendations that we make to take hold, because of the fact that they're reaching out to us quite late in the game. In a perfect world, you want to start your retirement strategies and your strategic approach to retirement 20 years out. But if you're anywhere between 5 and 10 years away from retirement, we can actually do wonders for you, your family, and your business when it comes to retirement distribution planning. Now, one of the questions that I have a tendency to ask in every retirement strategist meeting that I ask, or that I engage clients and potential clients in, and many a times we do these over seminars or webinars or podcast, is I always ask a simple question. You know, would you jump out of an airplane without a parachute? Now, unless you're planning to commit suicide, 100% of you are going to say, Bert, you think I'm crazy. There's no way I'm going to jump out of an airplane without a parachute. So now that we have established that the vast majority of Americans, unless they just want to die and commit suicide, will never, ever jump out of a perfectly good running airplane without a parachute, then the next question is, well, if you're either going to rent or buy a parachute, are you going to rent or buy the cheapest parachute that they have in the marketplace or at the store, or are you going to buy or rent the very, very best? I would argue that all of us on this podcast would say that we are definitely going to rent the very best that we can possibly afford. Now, that brings me to the topic of average returns versus actual returns. Whenever we do retirement distribution planning for clients, the first thing that we obtain is a copy of their financial statements, whether they're traditional mutual funds, 401ks, IRAs, investments in real estate, whatever it may be, because we want to do our due diligence and we want to make certain that we create an audit of all the investments that they have made in the past in order to determine the internal rate of return on those investments. Because you will find that if you invest in the stock market, the mutual fund companies and the financial institutions in the United States, they tend to bolster and talk about the average return of a portfolio, but very few of them, if any, will ever discuss the actual return on the portfolio. And the differences are enormously in nature. And many a times, the average return is much, much higher than the actual returns. Now, the market as a whole, the masses, they live on the average. Individually, we all live on the actual. And I'm going to give you some examples that I think are going to open your eyes the next time you look at one of your portfolio statements when you get them from the institution or the investment company. So let's take an investment of that you're making in a mutual fund portfolio. In the first year, you have a 50% loss. And in the second year, you have a 50% gain. Now, the average 2-year return for that investment of 50% loss in the first year and 50% gain in the second year, the average rate of return on that investment is 0. And that's what the mutual fund companies are going to be promoting on a regular basis. Whenever you're trying to find a mutual fund, and you're trying to do asset allocation within your portfolios, they're going to give you the 1-year return, they're going to give you the 2-year average, and the 3 years, the 5, the 10, the 20-year, depending on how long the investment portfolio has been around. So in this case, the average return for those 2 years is 0. But now let's go ahead and do the math. Let's make sure that we can actually put some numbers behind it so you can get a feel for what I'm about to talk to you about. So we invest $100,000 in this same portfolio. In the first year, we had a 50% loss. So now the $100,000 portfolio, the $100,000 portfolio is worth $50,000. But then in the second year, we get a 50% return, a positive 50% return gain on that portfolio of $100,000. Now, if we were at $50,000 after the first year, and now we get a 50% rate of return, positive rate of return in the second year, that brings our portfolio back to $75,000. But remember, we started with a $100,000 portfolio. So although the 2-year average rate of return for this portfolio is 0, 50% minus and a 50% plus for the second year, the actual rate of return on this 2-year portfolio is a 25% loss. Because remember, we started with $100,000 and we ended up with $75,000. In order for that portfolio to get back to $100,000 to that 0% rate of return, the portfolio needed to gain 100% rate of return in the second year in order to bring us back to 0. So there's a big difference between the average rates of returns and the actual rates of returns. Actually, let me go ahead and give you a second example. Let's say that in the first year, and now I'm going to be inverting the numbers because in the first exercise that I gave you, we showed a loss in the first year, and then we showed a gain in the second year. So let's go ahead and let's go ahead and invert the numbers. So in this portfolio, we have a 20% gain in the first year and a 20% loss in the second year. So again, the rate of return for the 2 years, the average, is a 0% rate of return. But let's go ahead and do the math now. So we invested $100,000 in this portfolio. At the end of the first year, we had a 20% gain, so that brings the portfolio value to $120,000. And then in the second year, we had a 20% loss. Now, most people, whenever I ask this question, will tell me that, okay, so in the second year, if you had a 20% gain in the first year and you went to $120,000, when you lose 20% in the second year, you should be back to $100,000. Well, in reality, 20% loss on $120,000 brings the portfolio value at the end of the second year to $96,000. So although you had a 0% average rate of return in this exercise, the actual rate of return on this portfolio was a loss of 4%. And by the way, I'm not including fees or anything like that the mutual fund company may be charging. So I've given you a little bit of the math there. Now let's talk a little bit about the history, because when it comes to retirement distribution planning, you have to be able to pay attention to history, because history does have a tendency to repeat itself. Now, let's talk a little bit about the Dow Jones. So the Dow Jones Industrial Average in December of 1999 hit a major milestone, because it was the first time in the Dow Jones history that the Dow hit 10,000 points. And it did that in December of 1999. Now, fast forward 8 years later to October of 2007, the Dow Jones again hit another milestone, and it ended up at 14,700 points. So it did extremely well. Now, let's fast forward to March of 2009. So because of what happened in 2008 and 2009, now the Dow Jones went from 14,000 to 6,700. And that was in March of 2009. And then it fought and it crawled and it did all kinds of things between March of 2009 and December of 2009. And in December of 2009, the Dow Jones ended up at 10,000 all over again. So that's what they call the decade of the nothing. The decade of nothing, because between December of 1999, when the market originally hit, the Dow hit 10,000 points, 10 years later, in December of 2009, the Dow was again at 10,000 points. So the average return over that period was pretty much zero. Now, let's go ahead and shift gears over to the NASDAQ. So in March of 2000, the NASDAQ, again for the first time in its history, hit 5,000 points. And it did that in March of 2000. Now, do you guys on this call know when was the next time that the NASDAQ hit 5,000 again? Well, it was almost to the day in March of 2015. So the NASDAQ went on a long-term hiatus between March of 2000 to March of 2015 to get back to 5,000 again. Now, if you are in retirement, how many times throughout your retirement life can you afford to have your portfolio go on a hiatus of a decade, maybe a decade and a half, like it did with the NASDAQ, and have a zero average rate of return over the 10-year period for the Dow and the 15-year period for the NASDAQ. See, what people fail to understand, and this is something that we try to educate our clients as they get closer and closer to retirement, because none of the financial managers or stockbrokers are in the marketplace want to have these discussions with their clients, is that the sequencing of returns totally matter when it comes to retirement distribution planning. See, the sequence of returns really have less of an impact on a portfolio of a long-term investor who's either no longer putting money into the portfolio nor taking any money out. So if you have $100,000 invested and you invest that money over a 25 year period, the sequencing of returns is not going to have such a major impact unless you actually start taking money or you start putting money in on a portfolio basis. However, the relationship between an investor's rate of withdrawal and the sequencing of returns does have a dramatic impact on the outcome of that portfolio. So once you're in retirement and you need to start taking money out of the portfolio, then the sequencing of returns is going to have a major impact in everything that we do. And what I'm going to do is I'm going to share with you an actual portfolio return over a 25-year period. But we're going to look at this portfolio return. First, we're going to look at it through the accumulation period, and then we're going to look at it through the distribution period. And we're going to divide the portfolio into two parts. We're going to divide the portfolio A, and then we're going to have portfolio B. And the only thing that we're going to do in this portfolio is we're going to invert the rates of returns that actually happen during that 25-year period. So again, during the accumulation rate, what are some of the things that investors are interested in? Obviously, they're interested on the average annualized rates of returns. They're interested in asset allocation because they want to try to minimize risk. They're interested in staying invested because they're not going to need this money. Let's say for a 40-year-old, they're not going to need this money until age 65, we hope. And then obviously the amounts of money that you're investing in the portfolio and so forth. So in this exercise, we're going to take a look at a 40-year-old that invested $100,000 into a portfolio of investments. And again, we're going to divide the portfolio into portfolio A and portfolio B. So in portfolio A, the investor went ahead and put $100,000 in. Obviously, in that portfolio, over a 25-year period, the portfolio had an average return of 8%. So at the age of 65, this 40-year-old had a portfolio value of $684,848. Remember, the original investment was $100,000. Now, in that portfolio that I just mentioned to you, the first 3 years were actually losses. So you had a negative 12%, negative 21%, and a negative 14% return. And then in the second portfolio, in portfolio B, we still had the same $100,000 investment. We still had the same 8% rate of return. But those negative years, we went ahead and inverted them. So we put them toward the end of the portfolio period, which was 25 years. Now, at the end of the 25-year period, the portfolio B still had an 8% rate of return, and the end-of-year value was again the same as portfolio A, $684,848. So because of the fact that the client made the $100,000 investment and did not touch that money, it didn't matter whether the losses occurred in the middle, at the beginning, or the end. If you didn't touch it at the end of 25 years, the client or the portfolio holder or the investor still had the $684,848. Now, let's fast forward to age 66. So now this client is going to start taking distribution, and he or she are going to take a 5% distribution out of their portfolio starting at age 66. So again, they started with the $684,848, and I'm going to do the same exercise on portfolio A and portfolio B, and all I'm going to do is I'm going to have the same 8% rate of return in retirement, but I'm just going to invert, as I did on the first exercise. I'm going to be inverting the rates of returns. So for portfolio A, taking that 5% and starting with $684,848, the investor or the retiree runs out of money at age 81. So pretty much this investor started taking income distribution at 66, and 15 years later, he or she ran out of money. So in this scenario, this client and this investor and this retiree actually ran out of money before he or she ran out of life. And that was a major, major problem because of the fact that there was no principal protection in place. Now, portfolio B, the client started with the same 684, 848, was taking 5% per year, but because the losses did not occur until the very end of that period, the client actually had, at the age of 90, the client still had $2,622,984. So how can it be that two clients have started in retirement with the same amount of money, the same distribution rate out of their portfolio, the same average rate of return over from age 66 to age 90 to a 25-year period? How can it be that one retiree ran out of money in 15 years and the other retiree does not run out of money, and at the ripe old age of 90, this retiree still has north of $2.6 million in their retirement portfolio? Well, the reason for that is the sequencing of returns. And what you need to be able to do is you need to be able to protect the downside of your investment, because it takes much more effort to climb a mountain than to go down the mountain. It's the same thing that if you're, coming down the stairs and then you want to go up the stairs, it takes double the energy to make certain that you can climb the stairs again. Now, remember them. These are the companies back in, that were major companies in the marketplace that actually many of them went out of business in 2008. Do you remember Lehman Brothers, Washington Mutual, Merrill Lynch, that was actually bought by Bank of America because they were broken, they were bankrupt, Chrysler, Enron, Countrywide Mortgage, that used to be the largest mortgage company in the United States. So I think the big issue for all of us and the conversation today is, how do you manage risk? Well, the same way of the exercise with jumping out of an airplane, there are three ways that you can manage risk. You can manage it through, risk avoidance. So if you don't want to die in a parachute accident, then you're just not going to jump out of an airplane. You can do risk management, which means, okay, if I still want to jump out of an airplane, I'm going to find the best possible instructor, the best school. I'm going to do research on the school. I want to make certain that they have, good credibility and trust with other jumpers that have gone before me. I'm also going to purchase or lease the best possible parachute in order to diminish my probability of risk and my probability of death. And then the other thing that you can do is you can do risk transfer. So remember, in a portfolio, when you get to retirement and you're still invested in the stock market and in mutual fund portfolios and so forth, the susceptibility of losses are always going to be there. So the key is, how can you manage that liability and still be able to come ahead? So when we have these discussions with our clients, the big question from them is, Bert, what's available? What are some of the programs that are available in the marketplace that would allow us to participate in the upside potential of the market without having to participate in the losses as they come along in retirement? So today we're going to discuss a little bit about some of the critical retirement annuities that are available in the marketplace. And also remember that our annuities are primarily designed for retirement distribution planning. And they're basically two types. You have your deferred annuities, and then you have your immediate annuities. Your deferred annuities are invested for a specific period in the future. So if you're 50 years old and you buy an annuity, well, you're not going to take money out until, you're 60 or 65 years of age. So that would be a deferred annuity. You're deferring that benefit to some time in the future. An immediate annuity will start making payments to you immediately. Many of my clients, when they hit retirement age, we set up an immediate annuity portfolio in order to cover their fixed and medical expenses in retirement. So they're very, very good once you get to a retirement age. But when it comes to deferred annuities, there are a number of them that you can invest in. You can invest into a fixed deferred annuity, which pretty much pays a specific interest rate for a given time. You also have the fixed index annuities, which are tied to a stock market performance. But because your money is not invested in the market, you get to participate in the gains in the market, but you don't participate in the losses. So you do have what I consider to be a safety net. And then you can invest in variable annuities, and those are the ones that are tied to the stock market performance, and there is no safety net, so you do have a susceptibility for gains and losses in those different portfolios. Now the big question is, which would be the best annuity for my retirement needs or your retirement needs? Well, it depends. And one of the questions that I do ask my clients all the time is, what's better, a hammer or a screwdriver? Well, the answer is it depends. If you want to put a screw into a wall, you're not going to use a hammer because, you might be able to get the screw in the wall, but it's not going to look very pretty. So it really depends on what it is that you're trying to do. And there are many different flavors of annuities in the marketplace, and all annuities do something a little different. So whenever you meet with a retirement strategist, or if you decide to meet with me at some point in time in the future, then your idea is to meet with someone that understands retirement distribution planning, that understands all of the different risks that are associated with retirement, and to make certain that they can help you protect those risks, not only on behalf of yourself, but on behalf of your family and your business for the rest of your life. So think of principal protection program in retirements as going to Baskin-Robbins, and they have 31 different flavors of ice cream, and then your goal is to pick the right flavor for you and your family. Now, what are some of the tax benefits of annuities? Well, annuity assets grow tax deferred. Now, if you invest in a tax-qualified annuity, that could be an IRA, a 401k, or a SEP, the contributions are taxed on the contributions that you made and also on the growth. So if you choose an annuity as the vehicle for you to put your 401k and IRAs, at time of retirement, you're going to pay taxes on both the contributions and or the distributions, the same as you would have if you had made that investment in a traditional mutual fund or a 401k. Now, non-qualified annuities, because of the fact that you put the money in after tax, but the money does grow tax deferred, then at time of retirement, you're only going to pay taxes on the growth of that investment because you had already paid taxes on the principal. Now, always remember that all annuity income is taxed at ordinary rates. Ordinary rates as opposed to capital gains in retirement. Now, tax-qualified annuities, again, the IRAs and the 401ks and the SEPs and so forth, grow tax-deferred and have contribution limits, and those limits are based on, the IRS code, and they most of the time change every year. Now, non-qualified annuities, which are the ones that you put money in after tax, they grow tax deferred, but they have no contribution limits. You can put as much money as you want in a non-qualified annuity. You don't have that option in a qualified annuity. Now, tax-qualified annuities have IRS penalties. They have the 59.5 rule, which is the 10% premature distribution, and they have the 70.5 rule, which is the required minimum distribution, which will be a 50% excise tax penalty if you don't take money at age 70.5 when you're supposed to. Now, if you're investing in a non-qualified annuities or non-qualified annuities, you do have the 59.5 rule premature distribution penalty of 10%, but you don't have the 70.5 or required minimum distribution rule penalty associated with non-qualified annuities. Now, when it comes to cashing out annuities, and these are some of the great features of annuities, is you have all kinds of different options. You can take out lump sum payments. You can take your money and run with it. You can get guaranteed payments for life. You can get guaranteed payments for a specific period. You can also have a joint and survivor benefit period payment that neither you nor your surviving spouse could ever outlive. And if you really think about annuities, they actually complement Social Security and pensions. By the way, just so you know, Social Security benefits that you receive at retirement, they're actually an annuity to you. And if you happen to be lucky enough to work in a company that pays a pension benefit, those pension benefits that are coming to you on a monthly basis are an annuity payment of those pension benefits. So annuities play, whether you want to or not, and will play a major role in your financial world. So the issue with fixed index annuities is one of the major problems, one of the major products that we promote to many of our clients. And again, we have to do our due diligence. We have to make certain that they fit. They're not for everyone. But it's like playing that if you go to Vegas and you want to play at the blackjack table. Now, you may not know much about how to play blackjack, but if you're actually sitting at the table, and when you sit at the table for the first time, the blackjack dealer says to all of you, says, "Well, hey guys, for tonight and for tonight only, we're going to change the rules of the game. So when you're playing at my table, you can either win or you can push." Meaning that there's no way that you can lose. Now, the big question I would ask all of you, how long would you stay at that table? And the answer better be as long as you possibly can, because you cannot lose money at that table. So you're going to be there as long as you possibly can in order to be able to win. And again, that's what happens many a times when you deal with fixed index annuities, because you get to participate on a percentage of the growth in the annuity, but you don't get to participate in the losses of the annuity, because the insurance company that is selling that annuity is actually absorbing those losses on your behalf. Now, there are some disadvantages to annuities, and you have to be careful with these. You do have surrender charges. You do have surrender periods, which may or may not be a bad thing. Obviously, we always do our due diligence. We want to make certain that the money that you're going to place into an annuity is not money that you're going to need immediately, unless you're going to choose an immediate annuity. But you have surrender periods. You could have 5, 7, 10 years, 14 years. So whenever we build a portfolio of annuities for our clients, we try to diversify, so that way we can create distribution layers that are going to give our clients flexibility and so forth. Now, you can always take money out of an annuity. Most annuity companies will allow you to take up to 10% per year without having to pay any type of penalties. And also you have annual participation fees depending on the type of annuity that you invest in. Now, variable annuities are very expensive. Your fees inside these annuities could be anywhere between 3 and 4%. Fixed index annuities, which we market quite a bit here at Cambridge, have no management fees and no additional fees for riders, at least with the type of annuities that we make available to our clients. Now, Cambridge and myself, we do not sell variable annuities because of the fact that we would be putting our clients' money at risk. And when it comes to retirement distribution planning, that is definitely something that we never want to do on behalf of our clients. Now, the key question is, once you understand that there are fees inside of all these annuities, the big question is, well, how are fees applied? And, the same way that if you happen to be invested in a traditional mutual fund portfolio, you're going to pay fees, then you have to understand, how those fees are applied in order to make certain that you can make the right decision for yourself and your family in retirement. So let's talk about mutual fund fees. The average mutual fund in the United States will have fees of anywhere between 1 and 2%. And those fees come in different flavors as well, but the average is going to be anywhere between 1 and 2%. Now, in a mutual fund portfolio, let's say you have $500,000 in a mutual fund portfolio, the fees are going to be charged every year. So if you make money on that $500,000 portfolio in 1 year, you're going to pay fees. If you lose money in that portfolio in another year, you're also going to pay fees. And what is most important, that 2% that you're going to pay is going to be paid on the entire account value. So if your $500,000 portfolio grew to $520,000 in 1 year, well, you're going to pay fees on $520,000. If that same portfolio lost money in the second year, so now your portfolio value went from $500,000 to $480,000, you're going to be paying fees on the $480,000. Now, when it comes to fixed index annuities, the average fees on a fixed index annuity, at least the ones that we deal with, are about 2.5%. And that 2.5% is used to offset the cost of the put options that are going to have to be purchased in order to make certain that the investors are protected from any market losses. Because remember, in a fixed index annuity, you don't have to worry about that 50% loss or that 20% loss or that 30% loss, because your account value is guaranteed not to lose money, and obviously the guarantees are based on the claims paying ability of the insurance company that issued the annuity. Now, what is interesting about fixed index annuities is that the 2.5% is only charged on years that you make money. So it is not charged on the years that you lose money. And that's a major, major benefit that fixed index annuities offer that traditional mutual fund portfolios will not. The other major difference between fixed index annuities and mutual funds in the portfolio is that those fees are not only charged on the years where there's a gain, but they're only charged on the gains, not on the total account value. So in the same exercise of the mutual fund $500,000 portfolio, if that portfolio went in one given year from $500,000 to $520,000, that 2.5% fee is charged on the $20,000 only, not on the other $500,000. But if in the following year that portfolio of $500,000 lost money and it went down to $480,000, then you don't pay any fees on that portfolio. And because it is inside a fixed index annuity, that portfolio would never be at the $480,000. It would still be at the $500,000 that started with in that given year. And then obviously, for variable annuities, you do, have the different investment options as well. Again, we don't sell variable annuities, but if you did purchase a variable annuity, you do have sub-accounts and mutual funds alike. In the fixed world, you have a fixed interest rate and/or inflation protected. There are some annuities that you can purchase in the marketplace that will allow you to have a fixed interest rate assigned to it. And the fixed index annuities, which are the ones that we use many a times at Cambridge, they're tied to a stock market indices, but principal is not invested in the indices. So there's a safety net, which is the one that I have been referring to. So if you want to protect yourself and your retirement and your family from the volatility of the sequencing of returns in retirement, then you want to, take a portion of your portfolio and put some safety nets around it and put it into an investment that will give you the ability to maximize the possible returns of the market without jeopardizing any losses in the portfolio. Now, the Cambridge annuity platform that we promote with our clients on a retirement basis once they qualify for our tax-preferred retirement blueprint, some of the questions that we get asked is, can I lose any money? And the answer is no, whether it is an immediate, a fixed, or an index annuity. Actually, it's all based on the claims paying ability of the insurance carriers, but the insurance carriers that we use have an A+ rating, and they have been around for at least 100 years. So, these are insurance companies that have the ability and understand how to manage risk from one year to the next. The other question that we get asked is, will my cash flow fluctuate? And the answer is no. Income can only go up. So we do have inflation hedging portfolio that we put together for our clients in retirement. Another question that we get asked, can these annuities generate income for life? And the answer is yes. And there are several different forms that we use with our clients and options in order to make this principal protection last for as long as the client and the clients will live. And also you have what we know as laddering and hedging. We do a lot of hedging strategies using fixed and immediate index annuities, and by doing so, we do have the ability to increase the annual income up to a maximum of 40%. So that's a win-win because it helps you protect against all the eroding factors of taxation, inflation, market volatility, interest rate volatility, and so forth, which is really, really good from that perspective. Again, obviously, I wanted to take a few minutes of your time to kind of share with you, what are the things that are very important for you to look at when it comes to retirement distribution planning. And also always please bear in mind the definition of insanity, which is, doing the same thing over and over again and expecting a different result. So, from a business perspective, you need to, have a call to action. So please feel free to reach out to us to see if you qualify for a customized tax-preferred retirement blueprint. And you may want to schedule a 30-minute video conference with me and my firm at no cost or obligation to you. Now, to get a hold of me, please feel free to reach out to me at area code 786-766-1042. You can also email me at my corporate email address, which is bert.salazar, SALAZAR, at Cambridge, F as in Frank, P as in Paul, LLC.com, or you can email me personally at Bert, BERT, at bertsalazar.com. You can also visit our website, which is www.cambridge, F as in Frank, P as in Paul, LLC.com as well to get more information. And again, my goal in every podcast and every webinar and every seminar that I do, not only to my existing clients, but also to new clients that are interested in learning more about what we do at Cambridge, our goal is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thank you so very much for spending a little bit of time with us today, and I look forward to seeing you again next week. Talk to you soon.